Welcome to PwC IFRS Talks, your source for all things IFRS. I'm your host, Raihazah Shaikh. In continuing with our theme on climate-related disclosure requirements, today's podcast focuses on the recently published Securities and Exchange Commission's, i.e. the SEC's, new proposal addressing climate-related disclosures. And to talk us through the proposal, I have Andreas, a partner in our US Accounting Consulting Services team, joining us today. Welcome to IFRS Talks, Andreas.
Thanks for having me.
So the proposed amendments impact both domestic and international entities that are registered on the SEC, and it's a requirement to include climate-related information in their registration statement and period reports. The proposal covers a range of disclosures, including but not limited to: number one, disclosing climate-related risks and their actual or likely impact on the entity's business. Number two, strategy and outlook. Number three, disclosure of greenhouse gas emissions, which would be subject to assurance. And number four, certain climate-related financial statement metrics in the audited financial statements. So there's lots of information to digest. So Andreas, where do you even begin? I understand that the proposal is almost 500 pages long, and you and the team have been very busy working your way through the proposal and preparing our draft comment response letter. So I'm sure our listeners will really appreciate a high-level summary of what it entails. Maybe we begin with perhaps what the SEC's objectives are in relation to the proposal.
Sure, and yes, it is a very robust document. So I think it's important to understand that the SEC is the securities regulator in the U.S., and their primary role is the protection of investors. And so part of the reason that the document is as long as it is that there's lots of references in there to academic studies, statements made by investors, surveys, other indications that information regarding companies' exposure to climate risks and opportunities, for that matter. It's not just a risk-focused analysis. That those are very important to investors at the current time. And so a lot of the text in there is just demonstrating that the information that they are requiring or proposing that they require, that is information that many different investors in many different forums have said, this is important information. We need more of it. We need it to be presented in a more consistent manner across companies and over time, such that we, the investor community, can perform the types of analysis that we would traditionally do using financial information, where we have that same level of everybody follows the same standard and have consistent reporting deadlines, et cetera, et cetera.
Yeah, and that's actually a really helpful lens to think of it from, the perspective of which the proposal is written. So, I mean, building on that, what are the themes in this proposal that are perhaps similar to existing IFRS reporting, if any? For example, where there might be overlap with existing requirements, such as IS1, perhaps?
Yeah, so I'm glad you asked the question the way you did, because most of the things that you read about these new standards or these proposals that are coming out from various bodies around the world is everyone's always focused on the differences, either between the different proposals or differences relative to existing reporting that's out there. And I think it is important to emphasize that there are actually quite a few similarities. I think one of the biggest things is, if you look at the proposal from the ISSB, if you look at what's going on with the EU, all of them are trying to leverage the TCFD framework as it relates to climate. And the SEC proposal does the same thing. And as a result, you see a lot of similarities in terms of the four pillars and things of that nature. So I think it's important that people realize that there's actually quite a few similarities. There are certainly differences, but that they have more in common than you might initially expect, which I think is a good thing. It's certainly, again, if you take into account that the goal here is to provide better information to the user community, I think the more consistency you have across industries and geographies, the better it will be for the user community. So again, the document tries to focus on what is significant information for investors. And so it is looking at risks and opportunities. There are some things in there, maybe very specific to your question. Like, for example, the SEC proposal says that they think the boundary for climate reporting should be the same as for financial reporting, which I think is basically what the ISSB has said as well. That's not necessarily what everyone is doing in practice today, and particularly for certain metrics like emissions, where some companies use a uh, a reporting boundary that's different than just reporting for the entities that they legally control and therefore would include in their consolidated financial statements. There's also some things in there around having comparatives. There is some understanding that maybe in the beginning, having historical information might be a challenge, so that there are some provisions around how to deal with comparables, in the initial phase. But similar to accounting standards or what the ISSB has proposed, I think the idea is that going forward, that you want to have comparable information, or prior period information. And then to the extent that there's changes in estimates and the like, there's guidance on how to deal with that. So again, very similar to what we're used to in the accounting world. In terms of specific requirements, I think there's a couple that really jump out. One is that they will require scope 1 and 2 emissions to be disclosed and audited. Scope 3 is more a function of, it's either A, voluntary, or B, if a company actually has a published target. And there's some question around what that means exactly, but that if you have a published target, you need to disclose scope 3, but that's not assured at this point, is what the proposal says. So that's one significant piece of it. And then the other piece is that, unlike the other ESG standard setters guidance at the moment, there is a piece of the SEC proposal that is actually inside the financial statements, where they would require some new disclosures about climate impacts on each financial statement line item. So each line item in the balance sheet, income statement, and P&L, to the extent it's material, but they actually have a definition of materiality that is probably lower than what most companies apply in practice. It's sort of a 1% materiality threshold, and they have quite a bit of detail in the proposal as to how exactly one would measure that 1%. If you have pluses and minuses, how to handle that, and things of that nature. So it's a bit of a new concept, but I think especially for companies outside the U.S. that are registrants inside the U.S., this will raise some interesting questions of, if the SEC is requiring this footnote and it's not something that you're reporting in your home country, how to manage that you might have, reporting in an SEC filing that's not in your home country filing. Is that tenable? If not, then maybe you have to put something into your home country filing that's not, explicitly mandated by IFRS or US GAAP as promulgated by the accounting standard setters.
Thanks, Andreas. That's actually really helpful insight, particularly, I think, just that insight in terms of the level of additional disclosure that might be required on an FSLI basis, materiality dependent. Is there anything else that you'd flag in terms of where the proposal goes beyond IFRS that might be subject for assurance, for example?
I don't think there's anything else from a assurance perspective. I mean, obviously, anything that goes into the financial statements needs to be assured. So that probably is the most significant deviation, because I think most companies are already either reporting scope 1 and 2, or preparing to do that, because that's very much a baseline sort of, I don't know, best practice out there. And I think most of the other standard setters are also requiring that. So the
Mhm.
fact that it's assured, will obviously, there'll be some effort involved in that, and maybe that won't be the case in every market around the world on the same timeline, although I think that the EU is moving in that direction too. So I would say this 1% rule inside the financials is probably the most fundamental difference, because it is inside the financial statements.
Sure, sure. And there's something you touched on earlier, just in terms of, I guess, how this proposal is built up. So, with reference to the TCFD, the Task Force on Climate-Related Financial Disclosures, and you also briefly, touched on the ISSB exposure drafts. There's also the European Sustainability Reporting Standards out there. In your view, how does the SEC proposal compare to them? Is there anything else that you'd add on your views and how they compare, maybe?
Well, so first of all, the SEC proposal is largely focused on climate, whereas particularly the EU proposal covers on all elements of ESG, but even within the E, right, the European proposal gets into biodiversity and water pollution and marine life and lots of things that are outside the scope of the SEC proposal. So the SEC proposal really is, while it's 500 pages, it's fairly narrowly focused on the climate issue. So that's probably the most fundamental difference, and then this idea that they are actually making changes to inside the financial statements, which I think the TCFD and the ISSB and what's going on in the EU, those don't directly impact the financials, right? They're more other parts of your sustainability report or other parts of the annual report. Now, the pieces of the SEC proposal that leverage TCFD, those are very much addressing disclosures that would appear elsewhere in the documents. So typically in places like MD&A, or what people outside the US often refer to as management commentary. And I think those requirements are fairly similar to what you see coming out of the EU, coming out of the ISSB. And then maybe the other thing that they have in common, the requirements maybe aren't exactly aligned, but there's clearly a focus on understanding how the company is thinking about and going to manage transition risks, right? So that's certainly something that all three frameworks have in common. There's sort of the absolute exposure to climate, and then there's the, okay, well, you're going to have to make some changes in your operating model or whatever it might be, or where your assets are located, or whatever the impact might be. But how are you going to go about doing that, and what are some of the costs and risks and challenges around that transition process?
Sure. Thanks, Andreas. I think that's helpful just to, I guess, understand how this all comes together, or, just giving our listeners that overview of how they might compare or where they might compare. I guess it'd be interesting to get your perspective on, what should entities be focusing on now? What would be your advice to those that are impacted by the SEC proposal? I mean, where would they look for more information, and how should they go about digesting the proposal?
Yeah, well, so I mean, obviously, you probably want to read through it, even though it is 500 pages. Like I said, if you have some familiarity with TCFD and with the some of the either the standards or draft standards that are out there from other bodies, a lot of it will be familiar, and so you'll recognize a lot of the same terminology and concepts, and so you can, if you have some familiarity with ESG reporting, I think you can work through it relatively quickly, notwithstanding the fact that it's 500 pages. I think probably the most important thing to understand is that this is moving probably on a different timeline than some of the other standards. So as of right now, there's a 60-day comment period, and based on how the SEC typically you know works through proposals, they can go from the end of the comment period to digesting the comments to publishing a final rule relatively quickly. So it's not at all outside of the realm of possibility that this would be effective like next year. We don't know yet. That's one of the areas that one of the questions that's open for comment. I'm sure plenty of people will say they need more time, but this is coming, and it's probably coming in a in a form that's not all that different than the way it's currently drafted. So companies certainly should read it and start to think about to what extent do they already have reporting and processes that they can leverage. So if you're already doing something like TCFD reporting, there'll be a lot there that you can work with. But they're certainly going to have to build some new processes, particularly related to the piece that's inside the financial statements, because that's not something that probably most companies, if any, are doing currently. So that's going to be subject to the same rules as everything else in financial statements with internal controls and the like. And again, since it's inside the financial statements, it will need to be audited. So all of that needs to be planned for. I would think about that almost like when you have a significant new accounting standard where you have a whole bunch of things that need to be lined up in order to be able to report under that new standard when it goes effective. This is probably not too dissimilar. There are, because the way this is written, it's written as a as a rule, and it's largely disclosure based, so it doesn't have the same accounting standard architecture maybe that the ISSB has, or even that the EU initiative has. So there are no doubt some things where people will have to write some policies and the like, because you can't just largely lift language out of a standard like you maybe sometimes can, when you're dealing with a new accounting standard where you have to create internal policies so that you apply consistently throughout the organization. So, but just there's a lot to think about, and like I said, the time around this may be fairly accelerated. The other thing that I think people need to think about is, while I mentioned that there are a lot of similarities between what's going on with the EU, what's going on in the UK, right? Because the UK is requiring TCFD for ever more public companies, at least, and what the SEC is requiring. And then we don't know yet what jurisdictions are going to adopt the ISSB standards. So that's another unknown. But one of the questions will be reciprocity. So there will be certainly multinationals that will potentially be within the scope of the SEC rules. They'll be caught up, at least in part, by the European rules, perhaps as the UK expands their reporting beyond public companies. Maybe they'll get caught up in that too. And one of the things that companies need to start to think about is, to what degree can one set of reporting be leveraged so that it covers all of these different requirements, as opposed to having completely separate work streams for each one. And that's going to be particularly for the larger multinationals who are going to be caught in more than one of these regulatory regimes. I would imagine that there will be an attempt to find a way to leverage as much of the reporting across all of the different regulatory requirements as possible. So that's probably, at least for those companies, would be on the top of my list.
Thanks, Andreas. I think it's definitely a really important point to reflect on, particularly for those where there are large multinationals impacted by the various different requirements, and how they sort of consider the extent of which the requirements can be leveraged. So a very, very useful insight indeed. And I guess in terms of the next steps of the proposal, you've mentioned that there's a 60-day comment period. It's very fast moving, and effectively we could have the proposal finalized in the very near future, even after the 60 days. So is there anything else you'd add in terms of next steps that you may not have covered?
No, I think that's a pretty good summary of what's going to happen. I mean, there's other uncontrollable factors, such as there's some in Congress who don't like the proposal. They're not currently in power, so there's probably not a lot that will happen at the congressional level, but there will no doubt be some lawsuits from certain states that are have large fossil fuel industries, because they feel like this proposal is targeting them in some way. So there are still some macro uncertainties, but whether that would stop the rule or just maybe have the rule change in some way at some point in the future after people have already adopted it is very unclear how that would all play out. So I think for the moment, you should work under the assumption that this rule will be finalized, later in the year and could be effective, as soon as next year. And if it's not next year, the year after, in which case, given how much is in this, that would still be a fair amount of work to get done, even if it's not effective until 2024.
Sure. And I guess that brings us up to the wrap up of the podcast. I think a very similar theme that has come throughout this podcast and the previous podcast we did on the ISSB exposure drafts as well is that it's a very pivotal moment in the reporting of financial statements, and this is a great opportunity to feed back views and concerns that entities might have. So again, just want to encourage entities that are impacted to read the proposal and respond as well. So thank you very much, Andreas, for joining me and our listeners today. I really appreciate you walking us through the proposal and sharing your insights. And thank you to our listeners. Tune in next time as I continue on my mini-series on climate-related disclosures and how this impacts or will impact financial reporting going forward. Until next time, stay safe and happy accounting.
The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.